Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about C Limited. C Limited is a Pan-Asian company facing the consumer. It has three different segments: digital entertainment, e-commerce, and financial services. So we're going to talk through about why the crown jewel is the e-commerce business and why that's so attractive, but ultimately I'm going to highlight to you why the digital entertainment business, although it is going to be a dwindling part of the overall business, why that's important for shareholders, and ultimately we're going to talk about its valuation. So a lot to get through. So what's quite interesting about C Limited is that in 2020 this stock exploded to the upside. Now in 2021 it's still up more than 65% year to date. So it exploded significantly and it just carried on that momentum, and there are good reasons for this, so we're going to unpick some of that. So here's the thing: for Q3 that reported yesterday, the revenue was up 122% year over year. Okay, so it's not only was last year the C Limited was growing at 100%, 102 in fact. This year it's actually accelerated. So even as it came up against the heavy comps of last year's period, it's actually accelerated. So it goes to the core, that's people saying that the digital transformations undergoing here, and you can see that's really playing out, and it's not showing any signs of really slowing down. Now, what I wanted to highlight for investors, for listeners, is here's the thing, right? So the e-commerce business is growing really fast. Okay, so they had 1.5 billion in revenues, but I highlight that if we just kind of think about this segment right now, it makes up 54% of C Limited. Okay, but if we make the assumption that it grows, let's say, by another 50% over the next 12 months, it would be on a run rate of approximately 10 billion in revenues. Okay, so that's the figure that we're going to come back to in a minute. 10 billion in revenues. Okay, then I wanted to highlight the digital entertainment segment. Okay, so bookings were only up 29% year over year. So bookings are an important leading indicator because the bookings come in before the revenue gets recognized. So if bookings slow down, which appears to be the case, then revenues from the digital entertainment segment will also slow down. Okay, that being said, so why does it matter? If the digital entertainment business is going to be a smaller part of the overall business, why does it matter if it's decelerating? Surely what everything is about here is the e-commerce business. So I've highlighted here. So these are just my assumptions. This is probably going to turn out to be wrong, but for the sake of discussion, over the next 12 months, I've made some assumptions and say, okay, the e-commerce business is going to be approximately 60% of the total business, and the digital entertainment is going to be approximately a third, kind of around about that. Okay, but the digital entertainment business makes up approximately 58% in operating profits. Now think about that for a second. Okay, for every dollar in revenues the digital entertainment segment makes, 58 cents becomes operating profits. So that's really attractive. Not only attractive, but that implies that as it grows, the digital entertainment segment, even if it's slowing down, it is able to channel and funnel that profitability and cash flows back into the e-commerce business, so that the e-commerce business can continue to grow and incur losses and grow market share. So it's kind of like, you can think about it as Amazon. Amazon's AWS is the profitable part of the business that is very stable and sticky, because nobody's going to churn out their cloud providers, particularly large enterprises. So you get a very sticky customer base, and it gives you a lot of cash flows, and you use that cash flows to fund the e-commerce segment. The similar thing here with digital entertainment. Digital entertainment is the profitable side of the operations. Even if it's slowing down, it's really going to give a lot of cash flows to continue growing e-commerce at a very fast rate. And what you see here is that for Q3 21, gross profit margins for the business as a whole reached 38%. So that was a 400 basis point expansion from the same period a year ago. So you can see that as the business is growing, even if the e-commerce business is not really getting a lot of positive operating leverage, it's getting a little bit, and together with the digital entertainment that is clearly just oozing in cash flows, all together as this grows, it's able to expand its gross profit margins. So even though the business is slightly unprofitable on a net income basis, it's moving in the right direction. It's not difficult to see how it's moving in the right direction. So let's talk about the valuation now, okay? So when I came to see this, it was like 14 times next year's revenues. First impression was this is an unprofitable company. But as we've just discussed, it's clearly moving in the right direction. They can continue playing this game of incurring losses on the e-commerce side as long as they're innovating with the financial services and they're able to plow back in those cash flows from the digital entertainment segment, okay? So as another comparison, I highlighted Mercado Libre. So Mercado Libre is priced at approximately 8 times forward revenues. Mercado Libre isn't quite as good as Sea Limited, okay? Mercado Libre's growth rates are all over the place, and it's a very unpredictable business. And you can see if you look up afterwards, the share price of Mercado Libre this year has been really, volatile. It's been difficult. So you're not paying a very large premium here for Sea Limited that's A, growing faster, B, more stable, and C, I believe has a lot more potential. In fact, Sea Limited is actually starting to grow market share significantly in Brazil. So when all is said and done, I wouldn't be surprised to see Sea Limited taking market share away from Mercado Libre. So it's kind of up in the air how that turns out, but I think it's quite an exciting opportunity all in all. So I wanted to just say, yeah, so Sea Limited at 14 times next year's sales is not as expensive as it first seems, okay? So it's growing very, very strongly. I suspect that over the next 12 months, it probably would still grow at close to 50%. I think that sounds quite reasonable. That's pretty much what analysts for the stock expect. And yeah, paying 14 times for sales is not that expensive for that. So I'm not invested here, but if you want to find out what kind of stocks I am particularly interested in, I'm looking for stuff with a few more hairs on them, where I can see a potential for a meaningful re-rating. So yeah. Don't forget to check out what other people say about my marketplace in the reviews, and I hope to see you soon. Okay.